100 grand loss in your first year and then 100 grand profit year 2. On paper you wouldn't pay any tax because you carry forward your loss against your profit and then that's it in there for your tax comps.
For how long can you carry?
As far forward as you wish. There was rules before April 17, I believe, where it had to be against a specific trade. So you might see your tax comps it split out. So it had to be the same trade. You could knock it off. Now it's all in one part and just carry it forward as far as you go. Your R&D tax credits. So I'll touch on this as well because it's really, really good for startup businesses, especially if you're in app development, because it's pretty likely you're going to be able to claim R&D. For small businesses, in a nutshell, try and think of every £1 you can convince HMRC is research and development expenditure, you get 33 pence back as cash, basically.
For every £1 spent, you get 30.
The way it works out, yeah. So,
No,
if
it's on the tax side. Let's say my tax bill is 100k and I spend on R&D 50k.
yeah,
So
I'm going to use the board. So there's two ways to do it. You can be profit making or loss making. So if you're loss making, HMRC will actually pay the cash into your bank account. If you're profit making, you're going to get a deduction from your profits and pay less corporation tax.
Yeah. Yeah.
Oh,
That's innovative.
right. Going to keep it easy again. So let's say in your accounts, you've had £100 of R&D expenditure, which HMRC have agreed with. What they give you is an enhancement in 130%. So that's £130. If you're a profit-making business, this £100 here is already included in your net profit figure for the year. It's already in your profit per accounts. What you can then do is take another £130 off in your tax comp. So let's say you made a £200 profit, instead of getting taxed on that at 19%, you're going to get taxed on 70 at 19%. Is everyone following that through?
So that's the difference between 200 and 130.
If you're thinking about it as a percentage, I've just used them. Basically though, so that's if you're a profit-making business. If you're a loss-making business, you take this full 230%, and HMRC pay 14.5% of that back to you as cash. That's what loosely works out your 33 pence on the pound if you work back through the percentages.
Sorry, come again. R&D is 100 is what you're invested in the R&D.
100 is your spend, so you've went out and spent some money doing some research and development. What we often find with apps and sort of the software behind it is...
Sorry, I didn't get 100% what you invested, and 130 points what?
The £100 is actual expenditure on R&D that appears in your accounts. So that's your baseline for salary. It's got to be expenses that go through your accounts and show in your accounts on research and development. So that's the starting point.
This doesn't hit your accounts. That doesn't go on your sort of profit and loss. It's just included in your corporation tax calcs that go to HMRC. It's like a made-up figure. It never really existed. Yeah. It's just a tax incentive. Does that make sense?
Yeah, because you're saying for £1, every £1 you have 33p.
But that's only if you're not making money, right? If
I
you're
think
lost,
I think maybe we skip the mathematics and say if you're making a profit and you've got R&D, you'll pay less tax than you would have done, and if you're making a loss, you can surrender that loss for cash. You don't have to. You can have the enhanced losses carried forward, but you can surrender for cash if you want. I think maybe we get some fact sheets.
Yeah, we have got a fact sheet to give out because it's a very, very big area of tax. I could probably sit here for an hour and a half separately talking about it. Definitely ask your accountants at the year end about R&D though.
Just out of curiosity, where does that all sit? Does that sit in your profit and loss, or will some of that
So-
go back into your income?
Oh, so the actual at the end, yeah. So if you've got your profit making, so you just pay less corporation tax, it's just a smaller tax charge goes through your profit and loss. This amount, it's like income. So basically there'll be a credit in your P&L, so it's like revenue or tax income if you want to call it that. We're all good there?
Yeah.
I feel like I've opened Pandora's box a bit on R&D.
Oh no, it's fine. The thing is that accountants can do all this, but it's good to understand.
It kind of shows the difference between the murky world of accounts and the even murky world of tax. They are two different worlds at times. People kind of wrap them together and they are different.
Happy to talk about R&D over a beer in more detail after if anyone wants to.
Make sure I'm stood at the other side of the room.
That basically just follows what we've sort of been through on the board, so around, you know, starting with your net income, so looking at your revenue and your expenses, have a good understanding of your margins, keep in mind that you might have to account for that at some point and the effect that's going to have on cash flow, also on your prices potentially. Keep on top of your PAYE and your pensions. You are sort of responsible for your employees. It's their tax that you're effectively paying over HMRC on their behalf. It's their pension scheme you're paying into. If you don't keep on top of it, they will write the employees and say that the employer's technically stealing your pension off you because they haven't paid it into the fund. Once you've got your overheads in there, then have to think about how the balance sheet comes into it. So when we were talking about the timing of payments. So if you know that you're going to make a sale, but it's going to be 6 months until the cash comes in for whatever reason, make sure that's reflected in your cash flow forecasts, and keep a good idea of what your supply is going to be like on you. So HMR sales need to be paid on time. What relationships do you have with your suppliers? Can you maybe hold up on them, paying them until cash reserves build up a bit? And like I say, if you've got any debt, you need to make sure that your capital repayments aren't going through your profit and loss. So if you take out a 50 grand loan and you're paying off £1 a month, that does not hit your profit and loss. It's not an expense. It's a pure cash outflow. So again, that might be overlooked if you're just too focused on the profit and loss. So how do we bring that in with the pitch deck? Once you've been through the steps, you will now have some actual sort of science behind the numbers you're putting into the pitch deck. So when we do this exercise, some people come in with the pitch deck first. We then went back through the sort of costs, the revenue mix, the pricing, and it just doesn't make sense. We can't get a good split between, well actually, you know, we've got 100%, if we went back with Spotify, you know, we've got 90% of people buying music videos and only 5% on music alone. It's not realistic. So if you can come in and have some science behind what figures you're putting in, then yeah, that's what you really need to show in your pitch deck. In terms of key areas to hit, this will sort of depend on going back to when we say where do you want to be in 3 to 5 years, and what sort of business do you want to be and what's your end goal there. But in terms of the sort of key ones, the investors will put scrutiny on your revenue, and they will usually ask for sensitivity analysis to basically say, I think you're being a bit too generous for yourself here. They will obviously have that net profit, because certainly the deals we discuss, it's that net profit figure built up over a number of years that is eventually going to give them the returns and they're going to get the dividends out of. If you're not going to be able to show them a net profit at any point, what's worthwhile investing in you? And then I would say runway and burn rate's a big one. They're going to basically ask, if I give you this money, what are you going to spend it on? Is it actually going to be used for growth, and how long is it going to last you? And it all boils down to cash. So yeah, I've said we'll touch a little bit on different sort of sources of finance, especially for sort of startups. So there's grants. So there's places like Innovate You, there's all sorts of grants out there. If you can go out and basically say that we're trying to do this, we're trying to do that, and there is a fund out there that believes in what you're trying to do, they'll likely just give you some free money. Be careful with that. It can sometimes mean you can't do R&D, or you can do R&D, but it's a different kind of R&D, and it's not as good as the 33 pence to the pound. And we sometimes see people that have come into us and they've had grant income from a while ago, and they've got a 10 grand grant and they've lost out on 30 grand's worth of R&D. So be careful on that. It is quite appealing though when you're a startup and someone's just waving some cash in pretty much nothing. Loans, like I say, there's the startup loans out there. There is sort of funds from Europe that help startups. Probably not going to last much longer. Again, it's not all about equity. That there is other options out there, and the benefit of that is you're not giving away part of your business. Like, this is your idea, this is your business. I think a lot of people rush out for investment. You've got to remember you're giving part of that away. You've got to think that you're giving it away too as well. Sometimes you see investors that like to get very involved. Some investors might like to be too involved, and that can have a positive or a negative impact depending on the type of investor. You might get some sort of angels that come in that have sort of maybe done a similar app to you, have already had an exit, got an absolutely ton of money, want to invest in similar apps, and they've got the expertise and the know-how and I've been there, done that, how can I help you? Or you might just have venture capitalists who give you some money and are going to be on your back until you give them that money back with some returns. It's also something to keep an eye out for.
Yeah,
like I say,
so it's not just cash, it's a relationship. So is it a relationship you want to live with? And I think that's going to be helpful to you out in the hundreds to you.
And like we touched on as well, there is like some incentives. So R&D is probably the most obvious one for tax and the most common. There is some other weird ones like video games. I don't know if anyone's making that is a game. There's certain tax rules around that as well, which can be quite good. I've just put this is a stolen image, but it's a good sort of timeline of basically the investment rounds or the raises that you'll often see in a startup.